Volume is what gives a price movement its importance. It's sort of like printing in a bolder font. It just demands more attention. I'm going to talk about that today. Stay right here. Hi, this is Tim from TradingStrategyGuides.com. The next time I see you guys, it's going to be a new decade. Sheesh, how could it possibly be 2020 already? So how do you plan to ring in the new year? I'll be at a friend's house with a group of friends. That'll be fun because they're a fun and funny group of people. Let me know in the comments below how you plan on celebrating the turn of the new decade. And don't tell me that it's not a new decade because there's no 0 year, blah, blah, blah. We already know that stuff. We've got a few days of holiday left. I would be careful trading for the rest of this week and even early next week. By the end of next week, though, everything should be back to normal. Today I'm going to talk about using volume to help with your trade entries. After that, we're going to look at an update to the trade setup on the cryptocurrency Ethereum Classic. I'll show you that shortly. First, we're going to look at the open trades, then later on, the trading maxim. Once again, happy Monday, guys. Remember to click the subscribe button and hit that bell so you don't miss any of these great goofy comments. All right, charts. The US dollar Mexican peso weekly setup is still moving right along. Still in it, waiting for it to hit the first target. As I mentioned before, this could take a while since it's actually a weekly signal. The Euro Swissy finally hit our first target this morning right here. I've taken half off and moved the stop up to break even right here at 10895-ish. I'm going to be following stops with the parabolic SAR on this one and see how we do. That means the stop on the second half will remain right here at break even until this parabolic SAR gets down here below that level. I talked about the weekly spot gold setup and its possible trigger on Friday. Well, sadly, we got the trigger, but it happened on 35% volume. So no trade here. I suspect this pattern is blown, but I'll watch it for a while and see what happens. Okay, I'll show you the Ethereum Classic setup shortly, but first, let's talk about using volume to enhance your entries. Last week we looked at using the price volatility via the ATR indicator for clues to a better entry. Today I'm going to talk about how I use the volume to improve my trade entries. For starters, the volume indicator shows us different things based upon the market we're studying. For stocks, the volume represents the number of shares traded. For commodities, the volume represents the number of contracts traded. For cryptocurrencies, the volume represents the number of coins traded at that particular broker. And lastly, for Forex, the volume represents the number of trades executed at that particular broker. For stocks and commodities, the number represents all of the trades on that particular market throughout the world because they are traded on centralized markets, for example, the New York Stock Exchange or the London Stock Exchange. Cryptos and Forex, however, are a decentralized market, and the volume numbers and the price you see are specific to the broker or price feed that you're looking at. For example, the Bitcoin chart shows that today's volume, at the time of this video at least, was roughly 4,500 Bitcoins traded today at Coinbase, since this is a Coinbase Bitcoin chart. The price is also specifically Coinbase's price and may differ slightly from, say, Binance or Bitfinex or one of the other crypto brokers. The same is true for Forex. However, there are price feeds for Forex that combine the trades of several brokers, but you will still find slight differences in price from one feed to another. And of course, the volumes are specific to that feed as well. Here are two different Euro USD charts from earlier today. The first one is from the broker Owanda, showing a volume of 40,183, and the second is from the broker FXCM, showing a volume of 117,185. These screenshots are only a few seconds apart, but you can see there's a huge difference in the volumes. Just to show you that the prices don't necessarily move together either, I'm going to show you these two feeds side by side, and you'll be able to see that they are close, but not exactly the same. The price on the left is FXCM, the price on the right is Owanda. This clip is doubled in speed and took place around 11 a.m. New York time this morning. The other issue with the Forex volume feed is the number you are seeing is actually the number of trades that have fired off for the time period. Some of those trades could be little guys that are trading 1 micro lot, or they could be bigger guys that are trading 50 full lots. So the actual volume is not really revealed. With all that having been said, though, I find through testing and experience that the volume in Forex is still a relatively good indicator of interest in a price move. So I just ignore the fact that it's not showing me actual volume. I use volume in two ways to improve my trading. Number one, I look for a decline in volume during the course of the consolidation patterns. There are always hiccups, of course. You can usually ignore them as long as the decline continues afterwards. I'm looking for declining interest in the consolidation pattern. As I mentioned last week, declining volatility is one thing that demonstrates reduced trader interest. Declining volume is the other thing. And number two, I look for a spike in the volume on the breakout. If declining volume during the consolidation indicates reduced trader interest in the move, then obviously increasing volume indicates greater trader interest, and spiking volume indicates a bunch of trader interest in the move. That's a technical term, by the way, bunch of trader interest. Okay, you hear that stuff from me every time I show you a consolidation pattern from which I'm looking for a breakout, but I also use the volume in this way. Today's setup is a modification of the Ethereum Classic setup I gave you a couple weeks ago. Here was the trade plan back on December 18th. We were looking at the descending triangle. As I've mentioned with descending triangles, the support level is still strong even if the downtrend gets blown. As you can see, our downtrend got blown out here over the last few days. My biggest concern is this spike up right here with this huge volume behind it. What you have to look at, though, is that this candle started way down here, pushed way up here, and then pulled way back. So where was this volume? Was it on this up move right here, indicating that the preponderance of traders is wanting to push it up, or what? To answer that question, you have to drill down. I drilled down to the hourly chart, and it didn't answer my question. But the 15-minute chart did answer it. The push up was on the 5:15 p.m. candle. That's U.S. Central Time or Chicago time, by the way. But the push down was on the 5:30 p.m. candle. And you can see that there was twice the volume on the down move as on the up move, indicating to me that some group wanted to push this up, but it was immediately slapped down by a much larger group of traders. That's how I use volume to determine where the majority of traders want to see the price go. Okay, time to look at the Ethereum Classic trade setup. Here's our new descending triangle on Ethereum Classic. The support level is still 345. I've just extended the downtrend line to include the new candles right up in here. And here's the trade plan. We will sell a daily candle close below the triangle or below 345. On the breaking candle, to enter a full-size position, we want to see the volume bar reach up to the volume average right here. If it doesn't reach the average but does at least reach 75% of the average volume, I'll open a half-size position to reduce risk. You can calculate the percentage by dividing this volume number by this volume average, and you should get at least 0.75. If you don't see at least 0.75, stand aside on the trade. The stop loss will be 1.5 times the ATR, and the first target will be 1 times the ATR. So let's say that this candle breaks out, closes right here. That will be your entry to sell. At that point, you will look at this ATR right here, multiply it by 1.5, and then measure that distance above the entry for your stop loss, and you'll measure 1 ATR below your entry for your first target. If after entering the trade we get a candle that closes back inside the triangle here, we'll take the loss right then and not wait for it to hit the stop loss. Our intention is that a breakout below this descending triangle should be explosive and hit our target fairly quickly. If the momentum goes away, we want to shut the trade down without taking a full stop if possible. When the price hits our first target, we'll close half the position for profit and set the stop loss to break even on the remainder. We will then follow stops as price moves in our direction until the market takes us out. Now, these two rules are the very definition of cutting your losses and letting your winners run. Typically, I do this with two positions. The first position has a stop loss and a take profit attached to it. That position will close automatically when the first target is hit. The second position will only have a stop loss associated with it, and that's the position that will be allowed to run. When the first target is hit, we will have to manually move our stop loss up to break even on the second position. I will risk about 2% of my account on each trade. And that's the new setup on Ethereum Classic. Remember, we're in the middle of a holiday week, and typically we're going to have low volume and high whippiness. So be very careful. Be sure to follow the rule of not taking a trade if you don't get at least 75% of the average volume. And also remember, my intent here is to tell you how I manage these trades. If you've already got a good trade management plan, use it. Things that work for me may not work for you. You have to understand your own mind to find the best strategies for your trading. And that's my intent for the trading maxims, to help control my emotional impulses and keep me on the straight and narrow path. A maxim is a general truth, fundamental principle, rule of conduct, or proverbial saying. The purpose of my maxims is to motivate me to discipline in trading as well as other areas of my life. I suggest you start your own list of maxims, things that you can say to yourself while you're trading or doing life to make sure you always do the right thing. Feel free to borrow from my list. And today is Tim's Trading Maxim number 28. Once you learn how not to lose, then winning becomes easier. That sounds like just the trick, doesn't it? Of course, if you learn how not to lose, you're going to win, right? Well, I don't exactly mean it quite that way. What I mean is this: when you learn to keep your losses small, then overall winning becomes easier. I've got another maxim that says essentially the same thing, but I think it's probably worded better than this one. It says we not only win by winning, we also win by not losing. Look at it this way. If we take 5 trades, and 2 of them are losses of $100 each, and 3 of them are wins of $50 each, that's a net loss of $50, right? Well, what if we only lost 75% on each of those losing trades? Then we're net break even. Better yet, what if our losses were only $60 each? Then our net would be a gain of $30. Did we win more trades? No. We just kept our losses small. But we turned it from a losing scenario to a winning scenario by not losing as much. That's why we cut off our trades when they close back in the consolidation. Yes, some of them would go on to win, but sometimes we find a way to get on many of those eventual winners and win anyway. But a significant portion of those that close back in the consolidation would have continued on and hit our original stop. So they would have been a full stop loser, and yes, I do track that sort of thing. And that's what we mean when we say cut off your losers early. Remember our daily Ethereum Classic trade plan here. We're going to sell a daily candle close below the descending triangle. If the volume is not quite average, go half size as long as it's at least 75% of the average. Your stop loss is 1.5 times the ATR, and your first target is 1 times the ATR. And remember to click the link below to the trade management video for more details. And don't forget to sign up for my free Trading Picks email list to make sure you don't miss any of these great picks. I send out 3 or 4 trading picks a week from all different markets, and you'll get to see them first. And the best thing is, it's free. I'll put the link below this video. Be sure to come back to Trading Strategy Guide's YouTube channel every week on Monday, Wednesday, and Friday at 3 p.m. U.S. Eastern Time for my new videos. Don't hesitate to ask any questions you may have. I'll either answer your question right in the comments or in a training video, or both. And remember, the only stupid question is the unasked one. And don't forget to comment below about how you're going to be spending your New Year's Eve tomorrow. As always, thanks for watching. Thanks for subscribing. Don't forget to hit the thumbs up below. Have a great New Year's, and I'll see you on Wednesday.